Hello everyone, going live a little early to check if my audio is audible and I am visible. Can someone please confirm on the chat box? I will wait for another 45 seconds before beginning. Sounds good. Looks like we are live. Hello everyone, my name is Divesh Harpalani and this channel is for ACCA students, the students of financial management and advanced financial management. This video in particular is for the students of AFM, which is paper 4 of the professional level. This is the first lecture for the students of AFM of ACCA for the March 26 exams and beyond. For those of you who have not attended the orientation video or the orientation class of this batch, there is another video which is uploaded on YouTube. You can go and watch that video, the link of which is given in the description below. However, I will just take a few seconds to recap what we discussed in the orientation video and slightly about me, my introduction as your faculty. So I am a chartered accountant by qualification, fortunate to have cleared CA with an All India rank 6 and 13 in CA Inter and CA Final respectively. I had done my articleship at Deloitte and have close to 5 years of work experience across private equity at Advent, which is practically where I ended up learning all the financial concepts that we ended up not just learning but living all the financial concepts that we study. Advent, for those of you who do not know, is one of the top 10 global private equity firms. I've also worked in management consulting at Bain & Company, which is one of the top 3 management consulting firms in the world, along with BCG and McKinsey. I'm also an international public speaker. I was fortunate to be one of the representatives of ACCA, which is the Institute of Chartered Accountants of India, to the CA Student Conference of CA Institute of Sri Lanka. And I have mentored about 1,000 plus both students as well as freshly qualified individuals. About ACCA AFM course, we had discussed a little bit about the course in detail in the orientation video, so you can go and watch that video. I'll not repeat everything in detail. However, in this course, you are expected to assume yourself or wear the cap of a future chief financial officer. And the aim of me in this batch is also to make sure not just that all of you clear, which of course is the first aim, but also that all of you become future financial professionals and thrive in those careers, whether that is as a future CFO of a multi-billion-dollar company or as an investment banker or any other such financial role that all of you will play. And that is exactly what ACCA AFM course expects you to do as well, which is it teaches you to understand the financial management world such that you are able to exercise professional judgment. You are able to make all those decisions in the real world that are required to maximize the wealth of your shareholders, your stakeholders as a senior financial executive, which is assume you are the CFO, you have to wear that cap of a CFO. The course broadly has 7 sections. The 7th one is broadly around the use of spreadsheets, etc. So broadly 6 conceptual sections that will be there. And within this, as we had discussed in the orientation video, section B and section E are the most important. For those of you who had watched that video, let me remind you of the analogy. This was you wearing the cap of a fortune teller, and advanced risk management was you wearing the cap of a insurance agent, which is protecting your business against all the risks, and acquisitions and mergers is nothing but you wearing the hat of a matchmaker. So of course I discussed a few more details in that video, not going into the details. The exam structure also I discussed in detail, but at the highest level 3 hours and 15 minutes, computer based exam. Only 3 questions, one 50-mark question and two 25-marks question each. And the most important is there will be marks awarded for professional skills. Sir, what is professional skills? And that is exactly what we learn in this batch. It is you wearing that cap of the CFO, and think of it as you are answerable to the board of directors of the company. How would you evaluate a particular investment? How would you manage the risk of a company? That is what you will have to convey to the examiner through the medium of your answer paper, and on the basis of that you will be judged from a professional skills perspective. Quickly, in terms of the batch details, we start today. Today is 10 January 2026. The batches will be live over the weekends, 5 to 8 p.m. on Saturday. Today we've started at 6, but otherwise it will be generally 5 to 8. Sunday it will be 11 to 2. The batch will be both live plus recorded. Most of the lectures will be live, but there will be also a few lectures which will be recorded, and all those lectures that will be conducted live will also be uploaded as the recording within 24 hours. The duration of this batch is between 90 to 100 hours, and the mode of this batch is fully English. There will be 2 to 3 block-wise tests and 2 full-fledged mock tests which we will solve live in the class. Of course, I will expect you to solve beforehand, and the entire solution of that mock test paper we will be discussing live in the class. And most importantly, there will be doubt solving sessions as well as my WhatsApp number will be available. It is also given in the chat box, and for all those who've enrolled for the batch will be able to reach out to me for solving doubts. So quickly jumping to the content now, but for those of you who've not enrolled and want to enroll, the details on the description below. You can get in touch with our counselors who will be able to give you the necessary advice. Without further ado, let's just get started with the first lecture of the Advanced Financial Management batch, and we start with chapter 2, which is investment appraisal. Because investment appraisal, like I said, belongs to section B, which is one of the most important topics. Before I go into the details of the content again, I just want to show you how these notes are structured. These notes will have examples. These notes will have certain practice questions. Of course, there will be a separate question bank that will be given to you. There's also questions on the ACCA Study Hub portal, but there's also certain practice questions that will be given in certain chapters, and there will be, most importantly, certain exam tip boxes, which for example is here, which talks about a lot of these common mistakes or things to keep in mind from an exam perspective that students should know of. So these notes are structured that way. If you refer to these notes, then there is no need to refer to any other concept notes, whether ACCA Study Hub or otherwise. Of course, if you want to, you can always use a second source, but these notes are pretty exhaustive and all the concepts will be covered from a concept perspective. Of course, from a question bank perspective and a practice perspective, you can always refer to the Study Hub and our question bank. Without further ado, let's just get into the content. Investment appraisal. So what is investment appraisal? At the highest level, you as the CFO, actually taking a full step back, at the highest level, you as an individual, your aim, of course, when you study ACCA also, in some shape or form, you know that this will help you increase your pay, or this will help you to get a good job, right? So for you as an individual, what are the 3 things when you think about money? What are the 3 things that you can think of? The first question that you will think of is, sir, how do I earn money? How do I earn money, or where do I get money from? Which is the same question that a CFO also answers, which is nothing but the finance decision, who says, how do I get the necessary funds to be raised to finance? That is the same question that the CFO also answers. The second question, once you've earned that money, you will ask yourself that question, sir, where do I invest it? Whether do I invest in mutual funds or fixed deposits or gold or silver? Of course, the price of gold and silver are booming by the day. What do you invest in? That is the second question that you will ask yourself, and which is the exact question that a CFO will also ask. Where do I invest? Which projects should I invest so that the organization makes good returns? And the third question that you yourself will ask, if you've earned a good money from mutual funds, if mutual funds is what you end up investing, or let's say you've invested in silver and it gives you good returns, now is the question where you say, sir, what should I do with this money? Should I spend this money, probably buy a Mercedes, buy a charter plane, what do I do? Or the other option is I can reinvest the money, which is again the third question. What do we do as a CFO? He or she will ask and answer this question, which is how much of cash should be returned to the shareholders and how much should be reinvested, retained in the business for reinvestment. So these are the three decisions, or these are the three questions that a CFO will answer for the business, and these three questions form the part of a strategic pillar of the financial management as a concept. And these cannot be considered in isolation. But before I come to that, what do these three decisions help into eventually? What are these aimed at? Sir, if I was to think about the same three questions for myself, how do I earn money? Where do I invest my money? And with the invested money, what should I do? Should I reinvest that money? When you ask these three questions to yourself as well, what is your ultimate motive? Your ultimate motive is to make sure that your wealth increases by the day. Probably for some of you, your aim might be to be in the richest few of the world, which I of course hope for, but don't forget me when you do that. Having said that, what is the eventual aim of you yourself is to maximize your wealth. Similarly, what should be the aim of the CFO? What should be the one goal of the CFO? To maximize shareholders' wealth. To maximize the shareholders' wealth. So all of these decisions are taken with the aim of maximizing the shareholder wealth. Now, each of these three decisions are interlinked to each other. Now, what is the linkage for example, what is the linkage between investment and finance decisions? Intuitively, if you have to make investment, you'll ask yourself that question, where do I get finance from? But not just that. At what rate do I get finance from? How much finance to get? For what duration do I get the finance? What is the risk profile of the investment and the finance that I'm getting? The bank may say, I want you to invest only in secured assets, not in volatile assets. Or the bank may say, I will allow you to invest in gold, but then for a gold backed loan, but then they will say if the value of the gold goes below 70%, you'll have to instantly repay or sell the gold. And what is eventually the asset backing in terms of the capital requirements? And each of these finance options, the home loan construct is different and a gold loan construct is different as an individual. Similarly, from a company perspective, depending on the tenure and the size of the project, depending on the risk profile, again, each of these things that we've studied, depending on whether they may attract a favorable financing term or not a favorable financing term, and in which case you may want to go for equity as the source of finance. So that is the linkage between investment and finance, which is the type of finance depends on the investment opportunity, and vice versa. The investment opportunity depends on the type of finance that you are getting, because it depends on the type of finance. Unavailability or availability of a particular type of finance can constrain the investment opportunity. For example, the bank may say, I will give you a loan, but my condition is your project should not go in a loss, otherwise I will require a payback of the loan instantly. These are called as nothing but conditions. The conditions of the bank related to financing are called as covenants, which may constrain the type of investment that I will make. So what is the linkage between investment and dividend? Of course, if you're earning returns, only then you'll be able to pay the dividend back, because these returns are ultimately distributed to the shareholders. So the level of these dividends and whether these are stable or not, are these one-time dividends or not, depend on whether the investment becomes successful or not. And it depends on the generation of returns. And hence, for a lot of companies which are growth focused, which keep needing capital to grow, they may choose to retain profits instead of giving it back to the shareholders. They will say, if I'm earning money from an investment, I will reinvest the money in the same investment, grow that investment. But for certain companies which are mature, they may decide to give higher dividends. For a lot of these IT companies like TCS and Infosys, they give hefty dividends because they have lower avenues to invest cash in. So they choose to give money to their shareholders. What is the linkage between financing and dividend finally? Now, before going into the content, just intuitively think, depending on the source of finance, whether it is a debt, that the company has taken, or whether that source of finance is an equity, your return to the stakeholder will also be different. If it is a debt, then you have to mandatorily pay the interest to the debt provider every year. However, if it is not a debt, if it is an equity, then in that case you can choose not to give them dividend, but you can choose to reinvest the same amount of money in the business. So debt finance, though cheaper because interest is tax deductible, it requires a fixed interest payment. So this reduces the amount which is available for dividends. However, equity financing is more flexible, but that dilutes the existing shareholders' ownership. So if there are existing shareholders and you have to do a new project, you don't have any cash, you will have two choices. Your first choice will be go to the bank and ask for money from the bank to reinvest. The second choice is going to be you probably do a QIP round. QIP is qualified institutional proceeds. You do a QIP round where an additional set of shareholders come, they pay you the money, and additional number of shares are issued, which means the existing ownership becomes diluted. The dividend policy signals the management confidence in the future cash flows and attracts specific investor categories if the management decides to go for a broader set of investors. Now think of it as a real world application. If there is a pharma company which is evaluating an investment in an R&D for a new drug, let's say if it is Pfizer which is evaluating whether they should invest and develop a COVID vaccine or not, they will ask them the same three questions. The CFO of Pfizer will ask the same three questions. Does the NPV justify the 500 million outlay? If assume the outlay was 500 million, he will say NPV. Now what is NPV, sir? We'll understand that in the next few concepts, but for those of you who studied ACCA FM, which is F9 paper of skill level, would know what NPV is. For those of you who studied CA would also know what NPV is. NPV is net present value, which is one of the methods to evaluate or appraise investments. So he will ask whether he should make the investment or not, whether this will give positive returns from an NPV perspective, whether this will lead to increase in shareholders' wealth or not. The second one is from a financing perspective. He will ask this question: should we use debt? But while it is cheaper, it is very risky. What if my R&D doesn't fructify? How do I pay back the debt? How do I pay the interest? The alternative is to use equity, which is of course more expensive, because if you also think of it yourself, versus a bank FD, which will give you 6-7% today, you may want to invest in share market with the hope of, the reason I'm using the word hope of, because share market returns are never guaranteed. They could probably lead to a loss as well. They could probably end up making a 25% return for you as well. But you will invest with the hope of at least a 12 to 15% return every year in share market. So equity is expensive, but it is more flexible, because at least in that case you won't have to as a CFO pay interest every year. And if dividend is a choice, if you retain profits for R&D that you invest in R&D, or you pay dividends to the shareholders, because if you invest in R&D but natural, your cash that remains to give to the shareholders of course reduces, which is why these are the three questions that a pharma company in real life, for example Pfizer, will also take. Now the integrated decisions recognize that maximizing shareholder wealth, the one motive, it requires optimizing across all the three dimensions. Which are the three dimensions again? Investment, financing, and dividend decisions. All the three dimensions require optimization to maximize shareholders' wealth. And in this regard now, investment decisions are absolutely important, and hence this chapter, which is nothing but appraising investments. But sir, what is appraising investments? On a very lighter note, if let's say you are someone, you would have heard some of these dating apps. I'm actually new to these, I'm new to the concept of these dating apps also. But let's say, for example, Bumble is what I've heard, right? A lot of people swipe left, swipe right. What is that? That is nothing but you evaluating that a particular person could be a fit for you or not. Similarly, investment appraisals is you evaluating whether that investment will give you returns or not, of course on a lighter note. Now the concept of free cash flow. again, for those of you who studied FM, F9 or CA would know this concept very well, but I am going to make an assumption over here that you do not know anything, and I'm going to start teaching all the concepts from scratch. So for those of you who already know it, please bear with me. Free cash flow is nothing but the cash generated by the business. Is it free cash? Is it cash available for free? The answer is no. It is not cash available for free, but it is the cash generated by the business that is not retained and reinvested in the business, which means it is not retained and not reinvested in the business. Which is not reinvested in the business, it is available to either give to the providers of capital. You can either give dividends or interest using that amount of free cash flow, or you can pay dividends or finance additional capital projects. The same investment does not need it. Now you can say, I will take this money and make another investment. If mutual funds are giving you dividends, the same mutual fund is not accepting more SIPs. What do? You will say, I will do another mutual fund and put money over there. The third option is you repay the debt. If there is an outstanding debt, you just repay that loan, or the last option is you just have your cash balances increased. So sir, is this free cash? No, this is not free cash, but this is cash which is not being used in the same investment. So either you can pay interest, you can pay dividend, or you can invest in another project, or you can keep it as a cash balance for you. How do we calculate free cash flow? Free cash flow is nothing but if it is a business. Think of it simply as a business. Which is a trading business hypothetically. It generates revenue. It generates revenue from the sales that you make. There's a cost that you have to incur to make the sales. And then there are future investments. What are the examples of future investments? Either you will put another machinery to expand your capacities, or you will have working capital requirement where you will have debtors, inventory. You will have a number of these short-term assets, let's say deposits that you will make. So you'll have all sorts of these investments that you'll make in a business. So your free cash flow is nothing but the cash that remains from the sales that you received after paying all the costs, after paying all the cost for the inventory, for accounting for the amount that is blocked in terms of debtors as well. That is nothing but the amount which is free cash flow. The other way to do this is operating cash flow. What is operating cash flow? For some of you would have studied in accounts. Cash flow, which is from a cash flow statement perspective, there is this thing called as operating cash flow, which talks about what is the actual operating cash that the business gives you, keeping aside interest, dividend, keeping aside new investments, keeping aside sales of assets. Only on a ongoing basis, what does the business give you in terms of, simply put, sales minus all your costs minus your tax. Simply put, that is your operating cash flow. And from that you will reduce your capital expenditure, which is additional investment that you put, and from that you will subtract any changes in the working capital, because as your business grows, there will be an additional investment in the working capital as well. What are the components? Components being revenue. Revenue is nothing but the cash inflow. You will receive money on sale of particular units. From a cost perspective, there are expenses, but this is excluding depreciation. Why does this exclude depreciation? Because depreciation is a non-cash expense. Depreciation is a non-cash expense. So we have to reduce only costs which are cash expenses, which are cash operating expenses. So let's say you pay the labor, you buy materials on cash, and so on and so forth. What could your investment be? Your investment could be you buying a new machinery for $25,000. Finally, working capital changes. Your year-on-year growth means your year-on growth in your debtors or receivables as well. Your inventory also becomes higher, and so on and so forth, which means it will require additional cash. But free cash flow is not profit. So why is it not profit? Think of it. I'll give you an example actually. Let's say your parents give you a promise that the first of next month, they will give you 20,000 rupees cash. The first of next month, they will give you 20,000 rupees cash. For those of you who are accountants, For those of you who are ultra conservative accountants, won't trust your parents and won't record it as profit. But for those of you who are reasonably conservative but reasonably optimistic as well, will say, okay, it's your parents, their promise will stay, they will give you the money on first day of next month. You will record profit today. You will record profit today in your books of accounts. But have they actually given that 20,000 rupees today to you to spend it? The answer is no. Can you use that money to buy my lectures today? The answer is no. You will have to wait until the first of next month. And hence, cash flow is facts. It is the amount that you have in your hand, but profits are opinions. Why are profit opinions? Because profit includes depreciation, which are non-cash, and for those of you who know accounts very well, which is probably all of you, depreciation has different methods, and there are a number of these assumptions that you can take which will change the answer on depreciation and hence the answer on profit eventually, which means profit is opinion. I may have a different method of depreciation, you may have a different method of depreciation, so my profit and your profit will be different even if our revenue and costs are the same. But our cash flow will be the same because depreciation is a non-cash expense, because cash flow is facts. It is what you have in your hand. Accounting profit is reduced by depreciation. Free cash flow is not. Free cash flow actually represents the actual cash which is available for distribution. Profit is an accounting construct. If you have 10 lakh rupee of profit in your books of accounts, but you have only 2 lakh rupee cash, can you pay dividend of 10 lakh rupees? Can you pay dividend of 10 lakh rupees? The answer is no. You cannot pay dividend of 10 lakh because your books of accounts has cash of only 2 lakh rupees. So the free cash flow actually shows the actual cash which you have available for distribution, but profit is only an opinion. It is an accounting construct, and hence, by the way, free cash flow is preferable. Now, for every sum, you have to check whether you have been giving free cash flow or you have been given profit. By the way, if you have any queries, please feel free to keep putting it in the chat box. As and when I keep looking at the screen, I will solve each of your queries. But free cash flow to equity is generally different versus free cash flow. What is the difference? Free cash flow for firm is before reducing the debt interest, but after you pay the debt interest. Free cash flow to equity means the cash that is available for distribution to the shareholders as dividend, that is your free cash flow, because you've already paid your interest obligations. So this is cash exclusively available for equity holders after meeting all the debt obligations. This will be discussed more in detail in the future chapters of equity valuation, but for now you just understand that this free cash flow for equity is the cash that is exclusively available for equity holders. But sir, what are the uses of free cash flow in financial statement? The uses are, one, of course, to evaluate whether you make investments or not, because only if you have cash will you be able to make investments, or actually in future, depending on what are the cash flows that the investment gives you, you will decide whether that investment is worth making or not. Cash flow is also used to evaluate how a company is performing, and it is also used to value businesses, which we will study in the future chapters. But free cash flows are nothing but relevant cash flows. Relevant cash flows is what matters to us from an investment appraisal perspective. But what are relevant cash flows? Relevant cash flows, actually, before I go into detail, just think of relevant cash flows as all those cash flows which actually will affect your decision making from an investment perspective. I'll give you an example. Keep aside investments. Think of you yourself in your personal life. If you are an individual, you have spent 500 rupees. You have spent 500 rupees at a movie theater on a movie ticket, of course. You go to the theater, you start watching the movie. In the first 10 minutes, you don't like the movie. At this point, you have to decide whether I want to watch the entire movie or not. At this point, is the 500 rupees relevant to your decision that you have to continue to watch the movie or not? The answer is it is not relevant, because whether you watch the movie or whether you don't watch the movie, you either which way spend the 500 rupees. So it does not matter. Unfortunately, alas, the movie you may have not liked, but you've already spent the 500 rupees. But you've not bought the popcorn yet or the Coke yet. What do? That cost of popcorn or Coke will be a relevant cash flow, which is if you decide to continue watching the movie, then you'll have to spend if you want to, of course, then you'll have to spend on that popcorn and that coke, which is a relevant cash flow. But on the movie ticket, you've already spent, and hence it is not a relevant cash flow. So that 500 rupees, will that decide whether you should invest the next 2.5 hours in watching the movie? The answer is no. So all the relevant cash flows, by the way, only these relevant cash flows should be included. Popcorn should be, but ticket price should not. Ticket should not, because you have already spent. So what is relevant cash flows? Relevant cash flows is all the future cash flows. Popcorn was a future cash flow that happens only in future. Forward looking cash flows that matter. Past expenditure is sunk cost. What are sunk costs? Sunk costs are nothing but those that are already committed before the decision, which in our example is the movie ticket. You've already committed, you've already spent for the movie ticket. Another example could be a market research that you had made to decide whether you should invest in a particular real estate or not. You did a market research for that. Now you've already done the market research. Whether the market research says you should invest or does not say you should invest, irrespective, that amount you've already paid. So does that affect your decision making? That amount, is it dependent on whether you make the investment or not? The answer is no. Even if you don't invest in the real estate, you would have either way spent that market research money, and hence it is a sunk cost. Only the incremental cash flows matter. Only the changes to the current, changes driven by the decision. Your decision of continuing to watch the movie will affect the amount that you pay for the popcorn. Yes. But will that decision of continuing to watch the movie affect the amount that you are paying for the movie ticket? The answer is no, because that you have already paid. Last but not the least, the actual cash flow movements. The non-cash items like depreciation and accounting provisions are to be excluded, because these are non-cash in nature and hence these are not relevant. What is not relevant? Sunk cost, the example we've already discussed. Committed cost, I'll give you a very relatable, probably for some of you, a relatable example. If you have, for example, if you have thought of going on a date and proposing your girlfriend or boyfriend, you've thought of going on a date, proposing your girlfriend, boyfriend, all the decoration, dinner, etc. is already paid for. You have asked your friend's friend to get him or her to that place, and that person said, irrespective of the answer, whether the answer to the proposal is yes or no, I need a treat because I'm doing you a favor. Now, tell me something, whether that answer of the proposal is yes or no, you have already spent for the dinner, so it is already a sunk cost. And you already committed to this friend that you will treat him or her, so that is already committed irrespective of the answer to the proposal. It is a committed cost that you will have to incur regardless of the decision. The next example is, of course, non-cash expenses, which we discussed. Depreciation, amortization, accounting write-downs, everything is non-cash in nature. That should not affect your decision making whether you should invest in a particular investment or not. Last but not the least, apportioned overheads. Allocated costs that do not change. Allocated. The cost is already being incurred. Let's say you are the same CFO that I told you about. You are the CFO of Reliance Limited. Reliance is evaluating whether to open Jio 2.0, another Jio, for example, right? And Mr. Mukesh Ambani says, or let's say the CFO of Reliance, which is you say, I will also be dedicating some time to the new project. So part of my salary needs to be allocated to that particular project. Is your salary getting increased because of that project? The answer is no. You are going to get the same salary that you are going to get irrespective of whether the project happens or not. Yes, in which case this is not a relevant cash flow. Let us discuss a few examples. Number one, market research cost, which we already discussed, is a sunk cost and hence not relevant because it is already incurred last year. Number two, new manufacturing equipment. You'll have to spend, it is a new equipment. Yes, it is incremental and it is a future expense and hence it is relevant. Annual rent of a new facility. This is not allocation of existing facility rent. This is a new facility for which you will have to incur additional rent, which is incremental and caused by the decision. If you decide to invest in the equipment, you'll have to take a new place on rent. If you decide not to invest, then there is no incremental cash flow and hence this is relevant. Allocated headquarter overhead. Reliance has a corporate office. Reliance will say, I will allocate some amount to Jio Point 2.0, but irrespective of the Jio 2.0, the amount that Reliance was spending on their corporate office is the same. Yes, it exists regardless of the project and hence it is not a relevant cash flow. The salary of the manager who is existing employee, who is just redeployed. He's an existing employee. He's redeployed. Then is it an incremental cash flow? The answer is no, because it is committed. It is regardless of the project. However, if they were to give you in the question that this manager is getting replaced by a new manager that they have to bring in his place, then the answer would have been it is an incremental cash flow because they are getting a new manager. Revenue from a new product, incremental and future revenue, and hence it is a relevant cash flow. Let us solve an example to do this properly. A company is launching a new software product with year 2 projections as follows. It is a new software product. The license revenue will increase by 7,50,000. Is it a relevant cash flow or not? Yes, it is a relevant cash flow because there will be an increase. There is development costs of 1,80,000. There is server infrastructure of 2,20,000. There is depreciation of software development. There is new equipment purchase of 3,20,000 and there is additional working capital requirement. Is development cost going to be there? Yes, because if the company launches a new product, only then it will incur development cost. But over here, if they were to say that the company has already developed and is now planning whether to launch or not, then already developed is a sunk cost. But right now they are saying development costs in the second year. This is the year 2 projection. There will be development cost in year 2 if they undertake the investment. Then this is relevant cash flow. There will be server infrastructure cost of 2,20,000, which is going to be incurred because of this. There's depreciation which we will ignore because it is non-cash. So ignore. New equipment purchase, it is a new equipment and working capital is additional and hence this will also be relevant. There is also tax which you will incur, which is relevant. So 7,50,000 is what you will earn as license fee. However, you'll have to spend development costs and server fee infrastructure of 2 lakh. You'll have to additionally spend on this new equipment purchase and you'll have to additionally spend on the working capital, which is why this is your free cash flow. However, you may also want to consider tax rate. Over here, we are saying this is before tax effects. However, you should ideally also in the exam consider the tax effect. Generally, tax is paid a year later. So in this example, my tax would have actually been 28% on profit, depending on whether I'm paying the same year or not. If you're paying the next year, then in that case, you will pay the tax next year. In year 2, you will pay the tax for year 1, but this is how you calculate free cash flow. The 55,000 depreciation is excluded as it is non-cash. Going to the concept of net present value. Net present value is nothing but before that, just some revision for all those of you who already probably studied financial management in ACCA skill level or CA. You probably know all of these concepts, but think of it as just the revision of the basic concepts of compounding and discounting. How is compounding calculated? Compounding is nothing but where your future value of money, we all know the concept of time value of money, where money today is worth more than money tomorrow. At the same time, if you invest money today, there will be a compounding in future. You will earn some interest, you will earn some returns. So your future value of money is nothing but your present value into 1 plus r, where r is the rate of return, and n, where n is the number of periods. For example, if I'm investing 100 rupees for 2 years at the rate of 10%, for 2 years, then this is nothing but 100 into 1.1 square, which is nothing but 100 into 1.21, which is 121 rupees. So your future value of rupees 100 in second year, value of rupees 100 in second year. Now discounting is nothing but the reverse of compounding. Think of discounting as the time machine which brings back the future cash flows to present, in case of normal cash flows, using the same formula. But I will say here you have to find present values. Present value is equal to future value divided by 1 plus r raised to n, which is, in our example, if it is 121 rupees at the end of second year, you have to bring some amount the first year, you will say 1 plus 0.1 raised to 2, thanks Gary, which is 121 divided by 1.21, and hence your present value of that 121 rupees of second year in the first year is 100 rupees. So compounding is taking money from today to future, which is compounding of your investment, but discounting is just the reverse. It is that time machine which brings back that money from future to today, Probably all of you know this example, but for compounding, just how real compounding is, and I'm using a very popular example, but it still matters. Even the slightest change creates a very big impact on the compounding, which is, and recently the new year went past, and you would have seen a lot of these posts, which is 1 raised to 365 is 1, but 1.01, just the slightest change, raised to 365, which is 1% improvement in you every single day, will search, it should be a very minimal number because it's just 1.01. The answer will surprise you, is 37.78. And if you actually don't improve, but you get worse by just 1% every year, then just imagine what the answer is. You will get reduced to just 0.025% of your original yourself. This is on a side note. Coming back, this by the way shows you the importance of compounding, but discounting, which is the reverse of compounding. Concept number 2, in case of annuities, and these are basic concepts which you would have already probably studied. This is, think of it as just the revision, which is why it is not in the notes as well. Annuities means annual cash flows. Think of it as a Netflix annual subscription, which you will pay for every year. That is nothing but annuity. The present value of annuities is nothing but the annual cash flow into the annuity factor. Now, annuity factor can be looked at in two ways. Either annual cash flow into annuity factor, either I put the formula, which is 1 minus 1 plus r raised to n divided by r. This is one formula of annuity factor. The other way to find this is, there are annuity tables which say this is the formula, but the other way to find this is, where you say if it is 4% interest for 5 years, you will look at 4% 5 years. If you are getting a particular cash flow of 200 rupees, your discounting rate being, your R being 4% and your total period being 5, then your annuity factor is nothing but 4.425. This is this is actually minus n. This is to the power of minus n. Yes. So this is one way, or look at annuity tables. In exam, however, you will have access to the spreadsheet, so this will be much easier for you. Number 2, perpetuity. Number 3, perpetuity, which is nothing but perpetually. What is perpetually? Forever, indefinitely, much after me or you or the syllabus lives, perpetually you getting or paying a certain fixed cash flow. For example, if there is a perpetual, there's two examples that I'll give you. One, let's say you own a property. You can keep getting rent perpetually from that property. You'll keep getting rent perpetually from that property. Or the another example is, if you invest in a bond which has, let's say, 10% interest rate, 10% rate of bond, perpetual, and you invest 1 lakh rupees today. What does this mean? The formula for perpetuity is nothing but where present value is 1 divided by R into annual cash flow. Over here, we know that your present value is 1 lakh. Your rate is 10%. You have to figure out annual cash flow. It is quite possible that you know the annual cash flow. You have to figure out the present value. So in this case, your annual cash flow is nothing but 1 lakh into 10%, which is 10,000. This is the formula of perpetuity. Now, in each of these cases, it is assumed for both annuities as well as perpetuities, it is assumed that, I am hoping you are all taking notes, because this is the concepts of perpetuity, compounding and discounting are not given in the notes, assuming that this sounds like okay. Of course, this is okay, but it is 10K. It is assumed that cash flows start at year one. What does this mean? If today is 1st Jan 2026, cash flows start at either 31st December 26 or 1st January 27. Cash flows start at one of these dates. However, if the question says that cash flows start today, then the formula changes a little bit. The formula slightly changes, where in case of annuities, your formula becomes annual cash flow into annuity factor, but your annuity factor earlier was for N, which is, let's say, in our example, 4% for 5 years, now becomes 4% for 4 years. 1 year reduces, instead of 4.452, it becomes 3.630. We will consider annuity factor for N minus 1, and then to this annuity factor we will add 1. Sir, why are we doing this? Because the value of money today, the 1 rupee today, 1 is equal to 1. The 1 rupee today is 1. However, the discounting starts happening from year 1. So we will say in year 0, if I was to plot this, year 2, year 3, year 4 and year 5. In our earlier example, this would have been, let's say, 100 rupees every year from year 1 to year 5. However, if it starts today, then it becomes 5 years, where your first year is year 0. The discounting factor for today is 1, and hence you will look at annuity factor only for 4 years now and add plus 1 to it. What happens in case of perpetuities? Where cash flows start today? Then in that case, versus the original formula of present value 1 divided by R into annual cash flow, it will be 1 divided by R into annual cash flow, which let's say was 10,000 plus the annual cash flow. So you will add one more. So if it was 10,000 annual cash flow that you are getting and a 10% interest rate, you will add 10,000 to it, which you are getting today. So the answer will be 1 lakh plus 10,000. Not okay, it is 10,000. So it is 1.1 lakh. So these are some basic concepts that I wanted you to revise before we go into the details of the concept of net present value. While these concepts you would have already studied from back in the day, whether in BCom, MCom, CA, CMA or ACCA skill level. However, I thought given we are starting from the base, let me at least revise some of these concepts for you. Coming to the concept of net present value. Net present value is, as the word suggests, it is the sum of all the present value of the future cash flows that are associated with an investment. If, for example, you are investing in that stock market, in 1 year you will make a 10% return, in second year you will make a 20% return, in third year you will make a 40% return, in fourth year you will lose 50% of your money. What is the annual cash flow? What is the annual cash flow, or rather the cash flow in present value terms, which is discounted at the firm's cost of capital? While we will study cost of capital in detail in future chapters, you assume for now that the cost of capital is nothing but the cost at which the firm is borrowing money from the bank. That is for the sake of simplicity. What does this represent? It represents the value added or destroyed by undertaking a project. The value added or destroyed by undertaking a project, which means hypothetically you've borrowed money from your bank at 7%. You are investing money at 10%. Your present value of the 10% cash flows, if you discount at 7%, will be higher than what you will have to pay to the bank, and hence you will actually be making some money, versus if your annual returns is less than that number, you will end up losing some money. So what is the net addition to the shareholder wealth? That is what NPV represents. The net addition to the shareholder wealth if NPV is positive. If you would have made 7% return, exactly 7% return, then your present value at 7% would have exactly been equal to the present value of your cash outflow, which is nothing but the investment. Then in that case, your present value equal to investment equal to borrowing, you are not making any extra money, your NPV would have been 0, and hence you are indifferent whether to accept or reject. But if you make a return which is higher than 7%, let's say you are making an 8% return, then the present value, let's say you are making an 8% return, the present value of that at 7% at which you are borrowing is going to be higher than 7%, in which case you accept, because you are making a net positive shareholder value. If this was 6% return that you make, and if you discount it at 7%, which is, for the sake of simplicity, 100 rupees, 1 year you make 106 rupees, you discount 106 by 7%, then your money gets reduced to 99 rupees, which means your NPV is -1, which means you have incurred a loss of rupee 1 in today's terms. However, if you would have earned a number of 108, then 108 would have been roughly 100.93. Then in that case, you would have made a positive NPV of 0.93. You would have created the wealth of 0.93 for yourself, and hence this NPV is something that you should accept, because it is creating a wealth. The 106 rupees is destroying the wealth, and hence you should reject the investment. We've already discussed the concept of time value of money, that 1 rupee today, $1 today is worth more than $1 tomorrow. If I was to ask you a question, actually time value of money is like that date. If I give you an example, if you are given an option where you go on a date today, you get a message saying let us go on a date today, or there is another message that says, we'll see tomorrow if you want to go on a date, what would you prefer? You'll of course prefer the 1 rupee today or the date today. Why? Because that 1 rupee today has an opportunity cost. If you have the money today, you can invest into gold, you can invest into silver, you can invest into stock market, you can invest into shares or mutual funds, and you can earn returns, and hence that 1 rupee will grow to more than 1 rupee tomorrow. More than 1 rupee tomorrow. If you don't invest, then the value of that 1 rupee reduces. Needless to say, the purchasing power of money reduces over a period of time. Tea. Just take a guess. What was tea costing in India? In 1960s. In a reasonable restaurant, the cost today, of course, is between 50 to 150 rupees. Reasonably so. What would it have been in 1960s? The answer is 7 paise in 1960s. That is the amount of inflation in India. That is the amount of inflation in India, which is why money loses its value. Money loses its value. The third is, of course, there is risk. If your friend borrows money from you today, says I will return to you tomorrow, there is a risk that he will not return the money. The more amount of time he does not return the money, the higher the risk, and hence with time there is a risk that is involved in terms of money. Now, these three factors, the discount rate or the cost of capital, considers all of these three factors and converts the future cash flows. The 106 rupees in my example get converted at 7% to the present value through the rate of discounting. What is 7%? It is that time machine which brings all the future cash flows to the present cash flows, and the method is nothing but discounting. For a project with, what is the formula of discounting? It is very easy, what we already discussed. The cash flow of year 1 divided by the cost of capital, 1 plus 0.06. What is 0.06? It is 6% interest rate raised to 1. For second year, it is raised to 2. Third year, it is raised to 3. Fourth year, it is raised to 4, and so on and so forth. That addition of present value of all future cash flows, and the cash flow today is nothing but NPV. NPV is nothing but the sum of all present value, the sum of present value of all future cash flows. Now, if an NPV of 500 is what a project has, what does this mean? It means that at 10% cost of capital, after accounting for the time value of money, after considering the time value of money, after considering the interest that we pay to the bank, if we are borrowing at 10%, we are getting an extra money of 5 lakh or 5 lakh rupee or 5 lakh dollar today if we were to make an investment, which is more in value than is required to satisfy all the providers of capital, because the cost of capital is only 10%. What you are making is higher than 10%, and hence the NPV is positive, which means there is an increase in the shareholders' wealth. There is an increase in the shareholders' wealth. How does inflation impact your NPV calculations? Check the examples over here. Just imagine, let's assume you are staying in a hostel. Let's assume you're staying in the hostel, and let's assume you're staying in a hostel where the mess food, you're staying in mess, you're staying in the hostel where the mess food has an inflation. Every year they increase the prices by 5%. Let's assume you travel by metro. You travel by metro to your office, to your college every year, and the price of metro do not increase because the government says we will subsidize any increase in prices. And the prices of you taking someone on date, which is let's say on a pizza date, the prices of that pizza date or that pizza increase by 15% every year. However, your salary, or let's say your stipend, is increasing by let's say 6%. What happens? Your stipend is increasing by 6%, which let's assume is the pseudo for the cost of capital over here. But your cost has increased by 5, 0 and 15%. What does this mean? your mess food, let's assume you are spending 100 rupees on each of these, 100 rupees on each of these every year. Then in that case, 100 rupees on this, 100 rupees on this, 100 rupees on this, 100 rupees on this. Then in year 1, on year 0, you will spending 100 rupees on this. Year 1, you will spend 105 on mess food. Year 1, you will spend 100 rupees on the metro. And year 1, you will spend 115 on the date, assuming you still have a date given the pizza prices. Your year 1 cash flow is nothing but 320. 320. You will have to spend 320 rupees in year 1 versus the 300 you would have spent. But sir, my salary or stipend will also increase. No, if it was 300 in year 1, now it is higher. Okay, what is your salary? It was 300. It increases by 6%. 6% at 300 is nothing but 318. What does this mean? What does this mean? Your salary increase has been lower than your expenses. In other words, every specific thing may have a different inflation. There may be a specific inflation for particular items. Wages may have a lower inflation versus energy. Wages may have a lower inflation versus energy. Materials will have a particular inflation. There may be some specific inflation for each of these items, but what will affect the business eventually, what affects the cost of capital, is the overall general inflation, which is the economy wide price increase average. But however, your specific spend items have seen a higher inflation. What happens then? Then you will have to, then there's a particular method which we will discuss, but this is the example of specific versus general inflation. Coming back, what is inflation? I think all of you by now know this is a 9th standard concept, but it is increase in prices that lead to declining real purchasing power of money. Real purchasing power as in today's terms, if I was to spend, what would that spend have been? That is the purchasing power of money, which is today. It keeps reducing. The 100 rupees could have bought a pizza today, but tomorrow it will need 115 rupees. And it fundamentally affects the investment, because if inflation rises, then the investors demand a higher nominal rates. What is nominal rates? Nominal is rates that include inflation. If I am a shareholder, I make investments in mutual fund, I will say I want higher amount of returns on that mutual fund, because some of my returns are eaten up by the increase in prices of pizza. So I want much higher than the inflation rates, which will increase my nominal rate of return. And because of that, your cash flows change, where your different items may have inflation at different rates. What is the formula? Before going into the formula, if let's say your real cost of money is, or let's say your GDP also, for example, there's a real GDP, which is, in our example of tea, not sure where it went, probably I rubbed it off. But in our example of tea, what is the increase in the number of tea cups sold in India? That is the increase in the real GDP. But the increase in number of cups in addition to the increase from the 7 paise to the 50 paise is the nominal GDP increase in India. So now if I was to use a formula, what will you say? You will say, sir, okay, it is nothing but my real rate of return which people need plus my inflation. Inflation is denoted as H. This should be my nominal rate. This should be nominal rate. So the answer is no. If the real rate is 6 and the inflation is 3, should the nominal rate be 9? The answer is no. Why? Because if you had 100 rupees, with inflation being 5 rupees, or let's say with inflation being 3 rupees, you need 1.03, you need 103 rupees next year just to compensate for the inflation, correct? Now on that 103 rupees, you also want a return of 6%. You always need that cherry on the cake, correct? So 103 into 106% is nothing but 109.18. 9.18 is the nominal rate over here. So This is the formula that is given by the Fisher, which is nothing but 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation. The same example that I gave, 1 plus 0.06 into 1.03 is 9.18. It is not 3 plus 6 is equal to 9. You should remember that. But what is the Fisher formula? Think of it simply as 1 rupee over your 1 rupee being in a burger, 1 rupee being the base bun. The inflation is nothing but the patty which keeps increasing. So there is a base bun and then there is a patty and then there is a cheese on the top. I'm sure most of you would be hungry by now given it's dinner time, but there's a cheese on the top which is nothing but your real rate beyond the inflation of 3%. You also need a cherry on the cake, you also need a cheese on the top, which is your real rate. So this is the formula of Fisher, which is nothing but, if you want to find real rate, 1 plus real rate is 1 plus nominal rate divided by 1 plus inflation rate. Now, if there are two inflation rates, if there is a general inflation rate and there is a specific inflation rate, not a special, a specific inflation rate, what do you do? In your cash flows in exam, if you have separate inflation rate for wages, for materials, for energy, what do you do? If there is only one rate, then it is very simple. You use the discounting rate as the real cost of capital. You just use the cheese. Because the patty does not exist, or the patty is of the same size. It exists, but it is of the same standard size. It is a general inflation rate. You use the real cost of capital, and it is only valid where all the items are inflating at the general rate, and this is simple. So when you have just one inflation rate, which is general rate, just one inflation rate, then you use real method, which is real cash flows. What do I mean by real cash flows? Real cash flows mean cash flows in today's terms. You do not increase the prices. And you use the discounting as the real rate. For example, over here in this example of mess food, if you were to have 5% or let's say 6% increase, right? You have to have 6% increase, then I wouldn't have done 100 into 106 back to 100 and back to 100. I wouldn't have done that. I would have simply added the 100 rupees in today's prices and use the real rate of discounting for them. But if there are items which have a specific inflation rate, then first of all you have to convert inflate to, which is exactly what I had done over here, 105, 100 and 115. So you have to inflate to the nominal cash flows, and then these nominal cash flows you have to discount at the nominal rate. What is the nominal rate again? It is nothing but your real rate, 1 plus real rate into 1 plus inflation. Most of the cases you will have to end up using the money rate, but only in the plain vanilla simple scenario when you have been given just one generic inflation rate and there is no tax in the sum, then you end up using real rate. But when you use real rate, you use real cash flows, real cost of capital. When you use money method, you use money cash flows, which is nominal cash flows, and you use money cost of capital. So you have to use RR or MM. The answer will be the same. It is two roads leading to the same cafe. You'll get the same food to eat, but it is two different roads. So either use both real cash flows and real cost of capital, or use both money cash flows, which is nominal, increase the inflation. With the inflation you increase the cash flows and then you discount using the money cost of capital. Let's look at another example. Why don't we solve this particular example? Let's say if a company invests 4.5 million in project engineering, there is a revenue increase where 2 million per year, which inflates at 10%. What is this 2 million? Is it 2 million at the end of year 1? No, it is in today's terms. Which increase at 10% every year. So if I was to prepare cash flow, let's say year 1 cash flow, I will say my revenue would be positive. 2 million into 1.1 is equal to 2.2 million. then my wage cost would be negative. Wage costs are inflating at lower, of course, sir, salary always increases lower than the company's growth. So my wage costs increase at 0.4 into 1.05, 0.4 into 1.05, which is nothing but 0.42, which is nothing but 0.42 minus. There is a spend that you will make on asset maintenance, the capital expenditure in the free cash flow formula that we had learned. So for the asset maintenance, there is 0.3 million. So by the way, this gives you your operating cash flow. This gives you your operating cash flow, which is 2.2 minus 0.42, which is 1.78, which is 1.78. Now minus capital expenditure, which is your asset maintenance of 0.3 million into, you have to inflate it again at 7%, at 7%. So 0.3 into 1.07, this gives you 0.321, 0.321. Working capital, changes in working capital, changes in working capital. Now this is the trick, this is the trick which should make always a separate working note to calculate working capital. There is a 10% of revenue increase which is required at the end of the year. So 10%, working capital is what? Working capital is 10% of sales, but you need this at the start of the year, at start of the year, which means for year one sales, if your year one sales is, how much is your year one sales? Your year one sales is 2.2 million. Your year one sales being 2.2 million, your year zero, you will need a working capital of 2 million into 10% is equal to 0.2 million. Your year two sale, what is your year two sale? Your year two sale is nothing but 2.2 million, which is year one sale plus the 10% inflation, plus the 10% inflation. So your year two sale would have been 2.2 into 1.1, which is 2.42. So what is 10% of 2.42? The 10% of 2.42 is 0.242 million, correct? Which is what you require at year one. But sir, I have already invested 0.2 million in year zero. So only incremental, only the change in the working capital, which is 0.042 million, is 0.043 million, or 0.042 million is nothing but 42,000, which is nothing but 42,000. Yes, it is 42,000. So this number is nothing but 0.042, which is additional amount of working capital that you will be investing in year one for year two. So why do we not invest 10% of 2.2 million? Because we had already invested, actually this should have been 2.2 million into 10%, 2.2 million into 10%, 2.2 into 10%, which is 0.22, and hence if I subtract 0.22 million from this, your answer should be 0.242 less 220. It is nothing but 0.022 million, which is 22,000. This is 0.022 million. So this is your working capital requirement. In the first year, you had already invested the 0.22 million, which is in year zero already invested 0.22 million, which represents the sale of year one. The working capital of year two, however, should have been 2.42 into 10%, which is 0.242. However, of that you've already invested 0.22 million, and hence you will have to invest only 0.022 million, which is 22,000. So this is your, and you have to ignore tax over here. This is your nominal cash flow at the end of year one. This is your nominal cash flow at the end of year one, which is 2.2 minus 0.42 minus 0.321 minus 0.022. 1.437 million or 1,437,000 is your nominal cash flow at the end of year 1. Now what do you do? If you are to discount these cash flows of year 1 into year 0, then what do? You use the nominal cash. This is the nominal cash flow. What is your nominal cost of capital? Your nominal cost of capital is nothing but, your burger is nothing but 1 plus cheese, which is 1.065, which is your general, which is your, actually cheese was 8%. Cheese is the real return that you want, multiplied by 1 plus 0.065, which is your patty. So 1.08 into 1.065 gives you 15.02% nominal cost. So if you now discount 1,437,000 divided by 15.027, this gives you your, in your year 0, your for first year cash in year 0 is nothing but 95627. I'm checking again, looks like something is off. 1,437,000 divided by 1.1502 gives you, my bad, 1,249,350. This is your year 1 discounted to year 0 using nominal rate, which is your method of money method. This is what we have done. We can quickly check 1,437, and you have to discount all cash flows at 15%. What is 15%? 15% is your nominal cash. This is free cash flow at year 1, which is actually nominal cash flow. So you will also discount it using the nominal cost of capital. Now we'll take a very short break of 10 minutes and we will start again in 10 minutes from now. See you soon. Hello, welcome back post this short break. Resuming our chapter 2, which is investment appraisals with the concept of impact of taxation on NPV calculations. The taxation in investment appraisal has two critical impacts. One is there's always a tax, unfortunately, there's always a tax for all of those who are salaried can relate how much it pinches. There's always a tax which reduces the operating cash flows because you have to pay tax on the profits. You have to tax the profits at standard rates. And number two, just like the concept of cashback, you will get the tax allowance on the depreciation, which effectively lowers your burden, which lowers your effective tax burden. This is like the cashback on the depreciation. Now, for tax purposes, you can simply not deduct the asset cost as simple depreciation, but you have to claim a tax allowable depreciation, which as per the UK laws, as per ACCA, is calculated on a reducing balance basis. You all know that depreciation can be calculated through two methods. There is a straight line method and then there is a reducing balance method. From tax purposes, this is a reducing balance method. The total tax allowable depreciation in the asset lives equals the cost minus the scrap proceeds. Is of course the standard formula of depreciation. The TAD is claimed as early as possible, and rightly so, because you would want to minimize your tax liabilities in the first few years. And the tax allowable depreciation, so the tax is allowed in every year of ownership except for the disposal year, where you do not get the tax allowable depreciation, but there's a balancing charge or allowance. What does this mean? Think of it as your prepaid card balance, prepaid SIM card, where you have recharged for ₹100. In the first year, you used 25, second year you used, let's say 20, third year you used, fourth year you used. Let's say in the seventh year, you still have ₹20 balance, which now will go waste. The government will say for each of the year where you have used your balance of your prepaid balance, you will get a tax allowance. In the last year also, if there is an unused ₹20 balance, we sympathize with you. For this ₹20, we will also give you a tax allowance. Although this will not be called as TAD, this will called as a balancing allowance. So if there is a balance that is left which you are not able to use, then on this balance also the government will say, I will give you a tax allowance. But sir, if let's say I had overused my balance, if this was -20, I have been given higher deductions of tax in the past, and my scrap value was actually higher than my tax value of the asset, and I get higher, then this means there's a balancing charge. You will be charged on the taxation on this ₹20, because the income tax department has allowed you extra ₹20 of depreciation. An example, an oil drilling company purchases an equipment for $5 lakh or $500,000, sells it for $180,000 at year 4, and it is 25% at reducing balance method. What does this mean? For the year 0, you purchase at 5 lakh. Year 1, what is your balance? Year 1, your balance is nothing but 5 lakh minus 25%. So your depreciation, what is your depreciation? Your depreciation in year 1 is nothing but 5 lakh into 25%. 5 lakh into 25%. In year 1, your depreciation is 1.25 lakh. What is your depreciation in year 2? Now, this was nothing but 3.75 lakh. So year 2, your book value was 3,75,000 to start with, 3.75, and on this you will be allowed 25%, which is 0.9375 lakh, correct? and your book value will be 2 lakh, and your book value will be 2,81,250. In your year 3, this becomes 2,10,937.5 minus. So what is the depreciation in year 3? Your depreciation is year 3 is nothing but 0.703125 lakh. Now at the beginning of year 4, this is your balance. But so 2,10,937 is your balance, but you sell it for 1,80,000, which means 30,937 is the balancing allowance. First year is 375, second year is 281, third year is 210, which means when you sell it for scrap value, your balancing charge of 30,937 will be allowable as a tax depreciation, because your total tax depreciation that you will be allowed, tax depreciation that you will be allowed is nothing but your cost less all the depreciation less the balancing charge. Now in this example, if I was to say you are able to sell it for 2,50,000, your book value was 2,10,000, but you are able to sell it for 2,50,000, then 2,50,000 minus 210,937. Actually, this is the next example. No, this is not the next example. 210,937. 39,063 is what you will have to. This is the balancing charge on which you will have to pay tax. So the balancing allowance on disposal ensures that the company receives the depreciation relief on an actual relief basis. And hence now your free cash flow formula, when there is a tax in the sum, it will be operating cash flows minus the tax on operating cash flows plus the tax relief from the TAD, which is tax allowable depreciation, minus the capital expenditure and plus the scrap proceeds. Do not forget, most people forget the scrap proceeds in the last year. You will have to consider. I'm hiding the solution purposely. Using the equipment from example 3, the company generates an operating cash flow of 220 every year, and the cost of capital is 9%. You have to calculate the NP of this for 4 years. Let us do this sum. So what is your annual cash flow? So first of all, year 0, year 1, year 2, year 3 and year 4, even year 5. And the tax is assumed to be paid 1 year in arrears, which is why we need a year 5, because the tax of year 4 will be paid in year 5. Now, what is your annual operating cash flow? So operating cash flow pre-tax. Operating cash flow pre-tax is nothing but 2,20,000. There is no inflation given in this sum, so there is a constant annual cash flow. 2,20,000. Oops, there is nothing in year 5 because your operations end in year 4. Now, what is your tax? Your tax is paid 1 year in arrears. So 2,20,000 into 32%. Your tax is paid 1 year in arrears. So 70,400 negative 70,400. This tax will be paid over here, negative 70,400. This is going to be paid 1 year in arrears. Now your depreciation, tax allowable depreciation that we calculated, what was it? It was for the first year it was 125, second year was this much, third year was this much, and fourth year was 30,937. So what is your TAD? TAD is these numbers. What is your actual tax saving on these numbers? So for first year on 1,25,000 TAD or 1,25,000 TAD, you save a tax of into 32%, you save a tax of 40,000 tax saving in year 1. Second year this number will be 30,000. Third year this number will be 22,500, and your last year this number will be 30,937 into 32% of tax rate. So this is nothing but 9,900. So again, this is a tax allowable depreciation will be allowed in arrears. So your year 2 you will get a benefit of this will be added because you will be getting a benefit of tax allowable depreciation. You'll be getting a benefit, and hence this is nothing but 40,000, 30,000, 22,500, and the year after that it is nothing but 9,900, which is your balancing allowance, Now, like I said, do not forget to add the scrap value that you will realize in the last year. What is the scrap value that you realized in the last year? It was 1,80,000, which you will get in the same year, and now you will calculate the present values. You will calculate the present values, which is 2,20,000. Here it is 2,20,000 minus 7,400 plus 40,000. Here it is 189,600, and so on and so forth. This is not the present value. This is actually the cash flows every year. Now you will multiply this by the present value at 9%. So 1 divided by 1.09 for the first year will give you 0.917. Second year, 1 divided by 1.09 equal to is nothing but 0.842. Now, so on and so forth, you'll keep doing. So your present value is nothing but, for each year you have to do this math, which is your cash flows into the discounting rate, which will give you your present value. So 1,896,000 into 0.842 for second year, this number is 1,596,43. It looks tedious, but you will have to in the exam do it in spreadsheet, which is much easier, trust me. But effectively what this means is, when you do the addition of all of this and reduce the original investment, you will be able to come to know your NPV. You'll be able to come to your NPV. Like I said, first year investment is 500k, second year 220, but no tax. Third year, your tax after tax, your operating cash flows after tax. But sir, there is a fourth year tax. Where does that go? That is over here. The 220 and 189,600 that we had computed, these are the free cash flows. Now you have to discount all of these at 1.09, 1, 2, 3, so on and so forth, which is what is exactly done over here. 3, 4 and 5. This is how you calculate NPV. The NPV is positive, which means that you have to accept the proposal, but it is lower than stated because of a year 5 drag and the precise TAD. So in the year 5 you will get the tax shield of 9,900. also you will have to pay the tax also. Now the tax treatment considerations from an exam perspective, there may be certain variations that the examiners may test. They may say, instead of a 25% TAD, instead of a 25% reducing balance method, they may say your first year is 50%. Every year after that is 25%. They could say you can get 100% first year because they want to make investments attractive. There could also be possible that there are changes from reducing balance to straight line. In the question, you have to be mindful what is exactly being asked. And last but not the least, they may also say that the tax is paid in the same year versus 1 year in arrears. You have to look at the question carefully. Generally, what they ask is 1 year in arrears, but if they say you have to pay tax in the same year, you need to know. There's another example which is given over here. We can we can take a look at this. This is actually quite similar to the previous example that you had solved. I will not solve this. I will just take you through this example. Your revenue, so it's a pharma company which is investing 8 million. Your revenue is 5.2 million annually, which is inflating at 7%. So then, and there's a revenue which is inflating at 7%. There's a costs which are inflating at 4%. Is inflating at 4%. There are maintenance costs, which is capital expenditure, which are inflating at 6%. And there's working capital at the start of each year, which means at year 0, I have to pay working capital for year 1. At year 1, there is working capital for year 2, and so on and so forth, which means for my first year, I will have to pay for my first year. Actually, this actually is year 1 cash flow. This should have been year 2 cash flow. So this is incorrect. I will say you have to calculate year 2 sales, which is nothing but 5,564,000 into 7%, and by the way, working capital will of course have the same inflation as sales, logically so. So 5,564,000 inflation at 7%. Your year 2 sales will be nothing but 5,953,480 is your year 2 sales. What was the year 1 working capital? Year 1 working capital which you had paid in year 0 was nothing but, what is your working capital? Working capital is 15%. So it was 15% of 5,564. It was, I'm calculating it here. It was 15% of this number. So 5,564,000 into 15%, which is 834,600. So 834,600 was your working capital for year 1. For year 2, what is your working capital? 595,3480 into 15%. Your working capital should have been 893022. So what is your incremental? What is your change in the working capital? Is nothing but 834,600. The change is 58,422. So this actually will be 58,422. This number will also change. So now your first year cash flow is nothing but 5,564,000 minus 2,184,000 minus 636,000 minus 58422, which is 2685,578. This is your year 1 cash flow, and this you will discount at 13.4%. What is 13.4%? It's the nominal rate. What is the nominal rate? How is it calculated? It is calculated using the real rate, which is the cheese, and the general inflation rate of 5%. So that is how we arrive at 13.4%. That is how we arrive at 13.4%. Clear? Very, very clear. Now we go on to the next concept, which is the concept of internal rate of return. Without going into the details of what the concept is, just intuitively think, if we are borrowing at 7% from the bank, from a bank, and let's say we are earning 10% from my mutual fund, from the mutual fund, then at this rate, I had told you there will be a positive NPV. There will be a positive NPV because my rate of borrowing is lower, my actual rate is higher. What is 10% here? 10% here is nothing but effective rate or effective rate of return, or which is also called as internal rate of return, which is the actual return which you are earning. Now, if you were to discount the cash flows at 10%, at this number, your NPV will be equal to 0. So IRR is nothing but the discount rate at which the NPV of a project equals 0. It equals 0. At 10%, if you discount, your NPV will be equal to 0 because your present value of all your cash inflows is equal to the present value of the investment that you are making, which means it is the effective rate of return that the project generates on the invested capital, which is the 10%. Now, if your 10% is higher than 7%, will you invest? You will absolutely invest. But let's say if your 10%, instead of 10%, your mutual fund earns you 6%, will you invest? No, you will not, you will reject. Now, if your mutual fund earns you 7%, will you invest? You are indifferent. Even if you invest, you earn 7%, you have to pay 7% to the bank. So you are indifferent. You will say, I can choose to invest or not to invest. I am indifferent. I am indifferent. How to calculate? How to calculate IRR? Most of you would have studied this either in BCom, MCom, or in CA, or in skill level FM. But there is a linear interpolation method, which is you calculate NPVs at two different discount rates. I will give you one example. One example is, let's say NPV at 10% of a project is 50,000. NPV at 15% of that project is negative 10,000. This is your NPV. Now, if you have to find NPV at 0, because this is the rate at which there is IRR. So the rate at which NPV is 0 is what you have to find. You have to find this. What will you do? You will use interpolation. How do you use it? You will say IRR. One sec. You will say IRR is nothing but the lower rate plus the NPV at the lower rate, which is the numerator, divided by the NPV at the lower rate minus the NPV at the higher rate into higher minus lower rate. In our example, what is the lower rate? The lower rate is 10% plus what is the NPV at the lower rate? This is the NPV at the lower rate of 10%. So 50,000. What is the denominator? NPV at the lower rate of 50,000 minus 10,000, because this number is negative 10,000. This is minus into higher rate, which is 15, minus lower rate, which is 10%. What is this number? This is nothing but 10% plus 50,000 divided by 50 minus 10. So this is 60,000 into 5% rate. What does this come to? This is nothing but 10% plus 4.17%, which is 50,000 divided by 60,000, which is 0.833 into 5%. So this is 4.17%. So my answer is 14.17%. This is your interpolation method, something that you had learnt in school. If you are given values at a particular number and you are supposed to find a value at a particular number, you use interpolation. Correct? L in our example was nothing but the 10%, which is the lower discount rate. H is nothing but the higher discount rate. NPV at the lower rate, NPV at the higher rate, which is typically negative if possible. Otherwise, any two NPV rates and you will be able to calculate IRR. However, in exam, there is a spreadsheet approach. There is a simple formula that you put in your Excel sheet and it will give you all the answer, and I will show you that shortly. Actually, why don't I show it to you right away? Give me a second. Give me 1 second. Perfect. So let's assume these are your cash flows. Let's assume these are your cash flows where your cost of capital is 10%. And your year 0 cash flow is 50,000 investment, negative 50,000. Year 1 is 20, year 2 is 15, year 3 is 22, year 4 is 13. Then using the IRR formula, you select all the values. It will give you the actual rate, which is the IRR. This is the formula of IRR. However, you can also calculate the NPV. NPV of this project at 10% of cost of capital is what? How to calculate NPV? NPV. The rate is nothing but 10%, comma, all the values. But for NPV formula, Unlike the IRR formula, you will select only values from year 1 to year 4, only those values which you want to discount. Only those values which you want to discount. Give me one sec. NPV of 10% and the values from year 2 to year 4. This is a positive cash flow. You will have to then add year 0, which is non-discounted, which means the NPV at 10% is positive 5.99. What is the NPV at IRR? We just studied that NPV at IRR should be 0. What is our exact IRR? Our exact IRR is nothing but 15 point, it's still not exact, but it's 15.6484%. And you will select all of these values. You will add year 0. Do not forget to add year 0. At this, your NPV is, your NPV is 0. Your NPV is 0. So at IRR, your NPV is 0. In the examination, you don't have to do this manual math. It is very simple. You just use the spreadsheet function, calculate IRR, and you can calculate NPV as put the rate, put year 1 to year n cash flows, and then separately add year 0 cash flows. This will give you your NPV. This is the formula. Coming back, so in examination, you will be spared and you won't have to do all of this math by yourself. How do you interpret the IRR? How do you interpret the IRR? You will interpret the IRR as, is the project's return higher than the cost of capital? Is the project's return higher than the cost of capital? If the answer is yes, if the project's return is higher than your cost of capital, which was the case in our example, which is 15 point something percentage was higher than 10% cost of capital, then you will say, oh, I am borrowing cheaper, which is also in my FD example where I said I will borrow 7% from the bank and invest at 10%. Then my cost of capital is 7%, but what I'm earning is higher than 10%, and hence I will decide to actually invest. And yes, the IRR will be higher than the cost of capital. And this also helps in assessing the risk, which is how sensitive is the project's viability to change in cost of capital. If your cost of capital is 7% and your IRR is 7.5%, then it becomes a very risky proposition, because what if because of changes in interest rates in the market, your cost of capital increases by 1%, then there's a very high probability that your IRR is on the borderline. Coming to margin of safety. Margin of safety is nothing but the difference between IRR. The difference between IRR and cost of capital is your margin of safety, which is, if your cost of capital is 7% and your IRR is 10%, then there's a 3% margin of safety, which means even if your cost of capital increases, even if my bank increases my rate of loan, even then I have a cushion of 3%, or vice versa. If my mutual fund returns come down from 10% to 7%, even then there is a cushion, which means this is a margin of safety. Projected of 15% IRR and 10% cost of capital is a 5% margin of safety, which is safe, but 10.5 and 10, there's only a 0.5% margin, which is very risky. Small margins suggest that the projects are very sensitive to the cost of capital, which can increase because of market changes or company specific risk adjustment, which is important, and hence the risk assessment is very, very important. While IRR is absolutely popular, it does have limitations. Everything in this life has limitations. Like, you will also have, your parents will constantly keep saying you have to improve on X, Y, and Z. Everything in this life has limitations. What are the limitations for IRR? It assumes that all the cash flows are reinvested at the IRR itself. I'll tell you what this means. Let's say, and while this may not mathematically exactly add up, 100 rupees invested at year 0 will give 40 at year 1, year 2 and year 3. Will give me 40 rupees at year 1, year 2 and year 3 if discounted at 10%. So here over here my 10% is my IRR, correct? Let's assume my cost of capital was 8%. Let's assume my cost of capital was 8%. Now what happens? This is a very good investment that you find where let's say you are getting a higher return versus forever. Now you get a cash of 40 rupees in year 1. Will you again, now once you've already gotten back money from that mutual fund, right? You will put money in another mutual fund, but that second mutual fund also give you 10%? The answer may not be yes. The answer may not be yes. I will show you what this means. It means that let me take a clean piece of paper and explain to you. What this means is, let's say year 0 you are investing 100 rupees. Year 1 you are getting 40, year 2 you are getting 40, year 3 you are getting 40. At 10%, so 40 divided by 1.1, you get 36.36. This is 33.06 and this is 30.05. Let's assume the summation of this is 100 because you are discounting at 10%. What this impliedly also means is that your year 1 cash flow of 40 is getting reinvested at the same 10% for 2 years, which means 40 into 1.1 into 1.1. Your 40 becomes 48.4 by end of year 3. This is your year 3 cash flows. Your year 2 40 rupees, becomes 44 in year 3. Your year 3 40 rupees, your year 3 40 rupees remains 40 rupees. So 48.4 plus 40.4 plus 44 plus 40, this is 132.4. Now at what rate do you discount it to become 100? What rate do you discount this to become 100 rupees in year 0? The answer is approximately 10%. Why? Because there is an implicit assumption that you are earning this 10% even between year 1 and year 3. But factually in life, once this 40 rupees gets released from that mutual fund, from that investment which gives you higher, is it fair to assume that you will still earn 40, the interest on the 40 in the second and third year will be 10%? The answer is no. The reinvestment could be in a different mutual fund. It could be in a different asset class, which may earn only 8% for you. Probably you return the money to the bank, which gives only 8%, and hence the IRR has a fundamental flaw, where it assumes that the cash flows are reinvested. The cash flows are reinvested at the IRR itself, in our example at 10%. However, factually they are often actually reinvested at cost of capital, which is 8%. If I do the math here, if I was to do the math here, 1.08, which is, if we were to reinvest the money at 8%, which is the company's cost of capital, then the answer would have been different. Equal to 43.2 and the 40 rupees over here, the number over here would be 129.856. 129.856. So give me one example. Give me 1 minute. Yes. So at what rate should this 129 discount for you to get 100 in the first year? At what rate? This answer will be actually less than 10%. I will tell you what the exact answer also is. Give me a sec. Give me 1 second. Give me 1 second. The answer is, I will just show you the math. The answer is if this is the year 0, this is year 1, this is year 2, this is year 3, then your return is actually 9.1%. So versus the 10% that we had assumed over here, my actual return is only 9.10%. Why? Because my reinvestment does not happen at 10%. My reinvestment is actually happening at 8%. My reinvestment over here is actually happening at 8%. Correct? And hence, because of this, your IRR is not a true measure of your project return, and NPV is superior. Why? Because NPV actually assumes that the cash inflows are reinvested at the company's cost of capital. They are reinvested at the company's cost of capital. Because IRR, it assumes that it is reinvesting the money at the IRR itself, then it is overestimating the company's true economic return. What is the second problem in using IRR? The second problem is, in standard sums or in standard situations, usually outflows are on day 1, which is in year 0. However, in unconventional scenarios, it may be possible that if you install a machinery, every 3rd year, 5th year, 7th year, 10th year, there is a service. There is a massive service that is required, usually in case of aeroplanes, for example. Then there will be outflows in the middle of the project. And hence in such situations, IRRs are difficult to calculate. There could also be no IRR. There could also be multiple IRRs. For example, a project with outflows at T0 and T2, but inflow at T3 may have multiple IRRs, which makes it ambiguous. And hence, it could also be that a single IRR is there, but there could be an acceptance even if cost of capital is greater than IRR. So when no non-conventional cash flows are there, where you invest in year 0, you invest in year 3 and year 5, and you have cash inflows in between, your IRR could give you a distorting picture. How do you rank mutually exclusive projects? To rank mutually exclusive projects, now think of it this way. If there are 2 of your friends, one of your friends says, I have earned 100% return in 1 year. Another friend says, I have earned 2 lakh rupees return in 1 year. What will you do? You will probably end up going with, or maybe this 2 lakh rupees, he says, I have earned 20% return in 1 year. What would you do? You will go with the guy who says I have 100%, and then you invest how much? Then you ask these friends, how much did you invest? The first gentleman nicely says, I invested rupees 100. The second one says, I invested 10 lakh rupees. Now, what is actually the better example? The better example is, you say you have earned 10 lakh into 20%, you've earned 2 lakh rupees in the first year, which means this one was a better investment, but 100% return on 100 rupees earned you only 100 rupees. So IRR, you may go for the 100% IRR, while the other friend, on the basis of NPV, the other friend will actually win. What is better? Here's one example that is given over here. There is an initial investment of 10 million. IRR is higher at 20%. There's another investment of 15 million. IRR is lower, but the NPV over here is much higher. And hence, what should you prefer? From an IRR perspective, you would have preferred project A, but NPV actually prefers project B, because the absolute return that you make is higher in case of project B. Now, In case of project B, now assume, now actually ask yourself this question: what is the objective of financial management? What is the objective of you in that role of CFO? Your objective is to maximize the shareholder wealth. And if you have to maximize the shareholder wealth, what do? You will have to choose the method which maximizes the shareholder wealth. Where does your wealth get maximized? Where 3 million is considered, through 3 million is higher than $2 million, and hence you will consider the outcome as per NPV. Take another example. Let's say if you want to go to the examination hall, there's two options of vehicles. There is one option where there is an electronic vehicle which has only 10% battery left, but it will run at 100 kilometers per hour. There is another vehicle which has petrol and it has sufficient petrol. It will run at 50% of the speed, or 50 kilometers per hour. Now, this first vehicle with lower battery will not be able to reach the examination hall. It will be able to cover only half the distance, even if the speed is higher. So, this is a classic example. What will you choose? What is it eventually that your goal is? To reach the examination hall, your goal is that any vehicle which makes you reach the examination hall is what you will prefer. And that vehicle, even if with a lower speed, of 18 versus 20, eventually will make you reach the examination hall, and hence you will prefer that, which is why NPV is superior. What does this mean? The NPV is superior. NPV is superior because there is a unique answer. There is one answer. There is no multiple solutions. Even if there are multiple cash flows, unconventional cash flows, there is only one answer, which is a unique answer. Second, it recognizes the time value of money correctly. It shows the actual amount or the absolute amount of returns in dollar terms, in rupee terms, whatever, which is it maximizes the shareholder wealth. Often the percentages, like the 100% that your friend would have said he would have earned, would have been distorting. However, over here, your actual wealth creation in dollar terms maximizes your shareholder wealth. And for conventional or unconventional, all sorts of cash flows, NPV. So even when your IRR fails, your NPV still succeeds, and NPV will continue to give the right answer. It ranks the projects correctly even for mutual exclusive decision. What does mutually exclusive decision mean? Whether project A or project B, similar to this, whether project A or project B, it will give you the correct ranking. The only issue is that it is less intuitive for non-finance managers. For non-finance managers, you would have said, if you, in your case, of course, you would understand because you're a future financial manager, but your friend who is not from commerce field, or who is not an ACCA student, or who is not studying from me, if you were to give him the same choice of 20% or 100%, he'd probably choose the 100% versus the 20%. And then you can come in and say, but you made a mistake because the 100% is on only 100 rupees, the 20% was on 10 lakh rupees. This is a very simple sum, so I am not solving. You can just use the formula of NPV. Or if you want, I can solve it for you as well. Actually, why don't we solve it quickly and then we can end today's class. So, very quickly, what is the initial investment? The initial investment is 35 lakhs. Then for first year, we end up getting 8 lakh. For second year, you end up getting 9,50,000. For third year, you end up getting 11 lakhs. For fourth year, you end up getting 9 lakhs. For fifth year, you end up getting 7 lakhs. Now, let me just put the years: year 0, year 1. What is your NPV? Like I said, NPV, the cost of capital is 13%, and hence the value starting the first year, not the year 0. Year 0 does not have a discounting rate, and hence it will be separately added. This is your NPV is nothing but negative NPV, hence reject. What is your IRR? your IRR is nothing but, and over here now you'll select all the values, your IRR is 9%. So while your cost of capital is 13%, your IRR is 8.73, and hence what should you do? Should you accept the investment or reject it? You should reject the investment because your NPV also negative, your IRR is also less than, your cost of capital, and your NPV also is negative, which confirms your rejection. Very quickly, the next question, the last one for today's class. If your IRR is 18% and your cost of capital is 12, another scenario, your IRR is lesser. What does this imply? Both have positive NPV. Which project carries a greater risk and why? Which project carries a greater risk? The one with the lower margin of safety carries a greater risk because it has only a 0.8% margin. What if the interest rates increase and the cost of capital increases from 12 to 13? Then even a small increase will make project beta unviable versus project alpha maintains a comfortable 6% safety buffers. If cost of capital rose to 13%, beta fails but alpha continues to thrive, and hence implication is beta is suitable only if there is a confidence in stable financing cost, that your financing cost of 12% will not change. Only then you should undertake project beta. That summarizes today's class. Hope this lecture was helpful. If there are any queries, please feel free to let me know in comments. For those of you who've already enrolled in batch, stay tuned. Tomorrow's lecture will be at 10 a.m. And for those of you who've not enrolled, you can reach out to us at the link or the phone number given below and express your interest. For anything else, please let us know in the YouTube comments. But having said that, all the best to all of you for your exams. Thank you so much.